the commodity is going to have volatility. You got to think about what is the average, what is the equilibrium price. I want to be a countercyclical investor. I want to get involved in commodities that are trading below their long-term average price. And so the answer is, if you see oil at 50, put some money into it, and you see oil run to 90, take some money out of it. It's a cyclical commodity. You want to be countercyclical.
This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds. Welcome to the FEG Insight Bridge.
Today, we're joined by Dan Pickering, founder and chief investment officer of Pickering Energy Partners, a firm dedicated to investing across the global energy landscape. Dan has spent more than 3 decades analyzing and investing energy markets, navigating multiple commodity cycles, geopolitical disruptions, structural shifts, you name it, he's done it. Before founding Pickering Energy, he served as co-president and co-investment officer of Tudor, Pickering & Holt, one of the most respected energy-focused investment banking platforms in the industry. Over the course of his career, Dan has built a reputation for combining deep sector knowledge with disciplined capital market insight, an increasingly rare blend in today's environment. The energy sector sits at the intersection of economics, policy, and geopolitics. And today, we're going to cover it all, from U.S. shale production to data centers, renewables, Venezuela, and even Russia. What a difference a day makes. This recording was made less than 24 hours before the conflict in the Middle East began. While the conflict may have altered some of the commodity prices mentioned in the podcast, most of the remarks are enduring. And some of Dan's comments, especially on Iran, are prescient. Please enjoy. Dan, welcome to the FEG Insight Bridge.
Good to be here, Greg. Thanks for inviting me.
Hey, Dan, would you introduce yourself and Pickering?
Sure. My name is Dan Pickering. I'm the founder and chief investment officer at Pickering Energy Partners. We're a 50-person firm located in Houston, focused exclusively on energy. We're advisors and investors, so we do everything from capital raising and M&A on one side of our business, as well as research. Buy, sell, or hold ideas on public energy stocks. The other side of our business is deploying capital in the energy sector, primarily here in the U.S., primarily in the upstream, primarily in the Permian Basin. So we're investors and advisors, and energy is all we do.
And we're excited to have you here because there is a lot going on in energy, and you've been doing it a really, really long time. So maybe to kind of set the table, how does this kind of current environment measure versus other environments we've had or you experienced?
First and foremost, what I'd say, Greg, is energy is a cyclical business, and the cycles tend to run long, 5, 6, 8 years at a time. And so within it, there are certainly structural trends that tend to play out. But if you get lulled into thinking it's not a cyclical business, that is usually when you get your head ripped off. So cyclical business, what's unique or interesting about this period of time is that the geopolitical element feels like it's elevating. And that's a function of the Trump administration and what they're trying to accomplish with affordability and low energy prices, a stated goal for $50 WTI, for instance. And then you've got OPEC and what OPEC's doing. And then you have conflicts in Iran. You've got the current conflict in Russia, which is a 9 million barrel a day producer. So we've got probably more geopolitical elements at play right now than we tend to have in the energy space.
With that backdrop, and we're going to cover all those items, and that's why I'm so excited that you joined us today. But let's start here in the U.S. and historically, the U.S. shale industry has really been the swing producer. Are we still the swing producer? And, where are we in terms of shale production and just inventory there? You keep hearing that maybe we're running a little bit too quick. These things are drawing down faster than we expected. So maybe the life of the basins might be shorter. Where are we with U.S. shale?
Yeah, great question. So for context, you go back 15 years, and The U.S. was a 5 million barrel a day oil producer. OPEC was the big gun. And then shale came along, and the U.S. did become the marginal producer. The U.S. went from 5 million barrels a day to 14 million barrels a day, provided almost all of the incremental capacity that was needed in the marketplace, and eventually oversupplied market. So now where are we? You're right. U.S. is beginning to mature. So we're now, 2004 was the Barnett Shale. So we're 20 years in to drilling shale. The great thing about American ingenuity is we can go fast, and we have gone fast, and we've drilled a lot of wells, and we have drilled up some of the best spots, and now we're starting to move to some of the less good spots. What that translates to is the U.S.'s ability to add a lot of production fast has gone down. And so what we're seeing now is that kind of on the margin, the incremental producer is OPEC plus and what they're doing. And some of the other big plays that have developed, like Guyana, that has come on in the last number of years. It's now a million barrel a day producer. And the other thing I'd say, Greg, and we'll talk about it later, I'm sure, is that we're now reaching the spot where it's going to be much tougher to figure out where the incremental capacity is coming from. And in that environment with demand still growing, I'll tell you now, I think we're in a worse before better environment for oil. But the back part of this decade is really setting up to be, I think, a really good oil energy company financial environment.
I still remember 15, 20 years ago where the shale revolution was a growth play. And there was a lot of private capital flowing into all the different basins in West Texas. And then we had the Middle East, the Saudis flooding the market, crushed oil prices. And really since that point in time, we've gone from kind of drill baby drill to capital discipline. So these are completely different companies, industries. It's gotten, it used to be like a lot of little private equity firms. They're gone. So talk a little bit about who the players are and really the kind of the Wall Street capital discipline that's come to the oil patch.
Taking a step back, the industry realized there was this fabulous growth opportunity. Capital flooded in. Private equity was big, starting dozens, hundreds over the period of 4 or 5 years of new companies to go out, attack shale, figure out where it was. Where were the boundaries in Texas? Where were the boundaries in North Dakota? Where were the boundaries in Appalachia? And so money flooded in, overcapitalized the industry, commodity prices came down, and essentially there was a come to Jesus moment, if you will, where investors said, wait a second, growth isn't making us any money. In fact, growth has been bad. We flooded the market. And so now we need you to behave like good corporate citizens. So they pushed the energy industry toward a free cash model that basically has said, at any given oil price, I want return of capital, whether that's by paying down debt, by paying a dividend, by buying back shares. But there's been a real push that says, give money back to shareholders, stop growing. And so now if you look at the big public players, most of them are in a no growth to maybe 1 or 2% volume growth sort of mode. So it's very much changed from a mentality perspective of grow fast as you can to make money and be financial disciplined. And I think that shift, which happened right around COVID, COVID took oil prices way down, and investors in the industry said things have to change. Since then, it's become really ingrained. So now, even with oil at 60, what you're seeing, mid 60s, you're seeing these companies very much focused on free cash generation. So it's a good evolution for the sector, in my opinion.
Yeah, it's good for the corporate health of these companies, but it's a bit of a paradox, right? Because you talked about earlier, the Trump administration wants affordability, right? So affordability really means an increase in supply, right? But a lot of these producers don't want to have more incremental production if there isn't the right price to support that. So how does that balance out?
Yeah. And going back to the question you asked, you said, who are the players now? One of the things when this industry exploded, the number of companies increased dramatically. And for the last 5 years, it's been shrinking. The private equity companies have sold to the public companies. And so the publics have gotten much bigger, which sort of makes sense because you need a bunch of companies to go out and figure out what there is. And then you need efficiency to exploit it. And the big guys get the economies of scale, et cetera. So there's been consolidation. There are a lot fewer players left, and the publics are a lot bigger.
On the corporate discipline side, I mean, we spoke about them wanting to be, kind of finding religion, but at the same time, the Trump administration wanting affordability. So, like, what is the price that balances this all out?
So the answer is $50, which is what the Trump administration wants, is not a good number. And Trump's comment of drill, baby, drill did not happen, right? Rig count is down in the U.S. and production levels have plateaued. So I think what we've seen in that dynamic is the incremental supplies come from other places. We've seen lower prices because OPEC came back. Was there some U.S. arm twisting there on the Saudis? I think there probably was. We're in an oversupplied market right now. Inventories are building. We've got some geopolitical things that are keeping price higher, but $50 oil's not a good number. It may be a good number for the Trump administration. It's a good number for all of your listeners because it'll mean low gasoline prices. But $50 oil is barely squeaking by. That is not a sustainable number. We think about 70 to 75 as the kind of price at which demand can grow and supply can grow with appropriate returns for the industry. And right now we're at 67. We've been spending time in the 60s. The forward curve is in the low 60s. And so the industry's got a great balance sheet because it learned it needed to have a great balance sheet. So right now the price is not good enough to want to grow. It's not as low as Trump wants. And I would say, again, right now we're probably headed toward lower prices to really find the appropriate supply and demand in the very near term. But it doesn't matter what the U.S. administration wants. When supply and demand tighten, prices headed back to that equilibrium level or above, I think.
I'd probably lose my podcasting card if I didn't talk about AI and data centers at some point. So let's do that. Let's talk about how natural gas can potentially solve some of the energy issues that we have here as we build out all these data centers across the United States. Where does that gas play?
If you look at what's going on in the gas market, so AI is a big deal. We have a lot of gas in the U.S. And so let's say that to start with. We're exporting a bunch of it. And so if you look between now and 2030, export projects that we know are coming on that have customers on the other side will add more demand than AI does. So LNG, liquefied natural gas, the exports are a bigger deal than AI between now and 2030. But, these AI data centers, they require a lot of electricity. In many instances, if they don't have access to the grid, they're going to build their own behind-the-meter power solutions, a lot of which the quick answer is natural gas, whether it's small turbines where you have a bunch of them or you build a big power plant. But natural gas is the answer in the next 5 years. And then folks are hoping that there's a nuclear answer or some more kind of low carbon answers. But in the near term, natural gas fired power is how AI is going to get its electricity. And so, we view it as important, not as important as LNG. And the two of those things make us pretty bullish on natural gas prices for the next couple of years, but not crazy spiking high natural gas prices. Right now, they're $3 an MCF, $3 to $4 an MCF. When it gets cold, gas goes to $7. I don't think we're going to see $7 gas because of AI or LNG exports because we've got a lot of it. But gas is the story for AI power for the next three to 5 years.
I'm glad you brought up the LNG exports. I mean, it's become such a big part of the market. Now, we don't have enough terminals, right? I know we have one on the Gulf Coast, and maybe there's one on the West Coast. How quickly can these come online, and what do we do with all of this natural gas? Is there a risk that there is these things, there's delays in getting these built? I mean, everybody likes the idea of them until you try to build them, and it's sort of not in my backyard. So maybe talk a little bit about the bottlenecks we have with LNG, and maybe globally who we're competing with. I know the Qataris are doing it. Who else is out there?
You've done your homework. So these plants cost $10 billion, $15 billion, and take 3 to 4 years to build. And so there's a number of them that have been under construction for a while, and we're going to turn them on ratably, primarily in the Gulf Coast, Texas and Louisiana, over the next 3 or 4 years. So that will take LNG exports from about 15 BCF a day, which is about 15% of U.S. demand, up to closer to 25 BCF a day. So it's a big increment. They're huge projects that take a long time to build. Exxon had a very highly visible project called Golden Pass that slipped a whole year from the time they thought they would turn it on to the time that they actually did. So you have to watch to see if those big projects move at the pace they're expected to. Who are we competing with? We're competing. LNG goes on a ship and goes across the ocean to other places. Who do we compete with? We compete with pipeline gas. So we're taking a lot of LNG to Europe. Why? Because Russian pipeline gas is now persona non grata. They've turned some of it off, and they're trying to completely wean themselves off that pipeline gas. We also compete with, you mentioned Qatar. The Qataris have a big, huge gas field that they've been delivering LNG on for several decades and will continue to. And there are a number of projects. LNG is typically the way you monetize stranded gas. So a country finds a bunch of gas, they don't have enough internal demand, they try to build a project to ship it somewhere else. So there's probably, in the cyclical side of this, in the 2030s, we'll probably have too much natural gas and too much LNG. Right now, because the projects cost so much, they tend to have long-term contracts. Right? Nobody's going to spend $15 billion if you don't have a buyer on the other side. So the projects that are underway, I think, are in good shape. The other thing I'd say, and then I'll stop talking about gas and LNG, is that in the 2030s, my guess is what you've seen historically, the Russians are the bad guys. We don't want to consume the Europeans don't want to consume their gas, but it's pretty cheap. And at some point, the animosity will fade, and those cheap pipeline imports will look interesting again. And so I think sometime in the 2030s, LNG will be battling Russian exports at some point.
And we'll get to that, because I think that's super interesting, all the geopolitics of energy. But before we go there, I also just wanted to ask you about renewables and kind of where they fit into all of this, because renewables, they have gotten better and better, and their break evens are cheaper and cheaper. But $50 oil and nat gas prices that somewhere that $2 to $3 range. I mean, that's pretty competitive too. So maybe talk about just the kind of efficiency, the cost benefit of renewables, and also kind of vis-a-vis the Trump administration policies on renewables.
Sure. So renewables have been going down the cost curve, particularly when we think about kind of the core renewable energy of wind and solar. So we've gotten a lot better and smarter about that. And remember that once these projects are built, their marginal costs are close to zero. The wind blows, that's free. Sun shines, that's free. And so once you sink the capital, that's a very cheap cost of energy. The problem with them has been intermittency. And so you can't count on the wind boiling or the sun shining. And so you've had to offset that wind and solar power with either hydrocarbon or thermal power fueled electricity, or you've needed a battery, and the batteries have been really expensive.
And not very good, right? I mean, that's kind of been the issue.
The challenge has been that
4 hours of storage or something.
Right. To offset the intermittency, you have to spend a lot, which is raising the cost of the solar power is cheap, but storing it is expensive, and then that raises the overall cost. And so what we've seen from the Trump administration, so I would say that there was a very big push to decarbonize. There was encouragement globally, tax incentives, et cetera, to put money into these projects. And then what you moved from is projects that stood on their own with their own economics to being subsidy supported projects. And that's expensive in a different way. You've got projects that deliver power, but the taxpayer's paying for them or somebody's paying for them that doesn't show up in the bill. Anyway, Trump calls it the Green New Scam and says they're going to, U.S. will do less. Solar incentives haven't been cut that dramatically. There's been a big fight against wind. What I would leave you and your viewers with is that decarbonization is an ESG, has gone from being the only thing people wanted to talk about to a terrible word. But behind that, folks are still investing in renewables because the math is okay even without subsidies, and decarbonization continues to get a push. So I think that battery technology is something to really watch to make overall renewable power as inexpensive as thermal power. And in the meantime, until batteries are really more affordable, you're going to have the backup, the reliable, turn it on, it works, of gas-fired power, coal power, specifically. So Trump isn't killing the renewables as much as he implies. There is an up and to the right around decarbonization generally, and we are a long, long way away from being able to wean ourselves off of kind of our traditional sources of hydrocarbon generated power to get to all renewables. So we're a long way away from it.
Yeah, energy transitions take multiple decades, and it's
multiple.
It seems like that is not going away. It's the direction we're going. It'll be slow. Batteries are the key to unlocking it, and in the meantime, you're going to need a lot of natural gas.
Yes. Well said.
All right, so let's talk geopolitics. Let's go through the bingo card. Maybe we can start with Russia. You kind of hit on it already. I'm always just we are now entering the 5th year of the Russia-Ukraine war, and I am still shocked that the Russians are selling as much oil and gas as they reportedly are. So how are they doing that?
Yeah. So the answer is their opponents are letting them, or the Western countries are letting them. The really interesting dynamic that Russia-Ukraine highlights is that punishing bad guys is less important than cheap gasoline and cheap natural gas. And so, that was a decision that all the Western countries took when they imposed these sanctions on Russia. If they really wanted to hurt Russia, they'd say, you can't sell any oil and gas. The problem with that is we'd be paying $5 or $6 a gallon here in the US and in Europe, et cetera. And that was too painful a move. So what we said is, well, you can sell, but it's going to be at a discount price. And so instead of complete financial pain, it's partial financial pain for the Russians. And we, the consumers of their hydrocarbons, still get those supplies. So what we've seen develop is that Russian crude flows, and it's a lot of oil. It's 9 million barrels a day, give or take. And we consume 103 million, 304 million barrels a day. So it's 10%, call it 10% of global capacity. And that's just too much to take out. So we haven't taken it out. It's been sanctioned. And those sanctions have gotten tougher, I think, as the U.S. administration's trying to push harder for resolution. They've now strong-armed India into buying less. India and China were the two big buyers of Russian crude. And so what you're finding is you're seeing building Russian inventories, building crude, on the water, if you will. So we're slowly tightening the vice. But I mean, as you said, we're into the 5th year now. And so I go back to this. I don't think the Western adversaries have the will to completely shut off Russian supplies. If they did, probably you're gonna get a quicker resolution to Russia-Ukraine, but the financial and political cost of that domestically is too high.
I guess I'm surprised that they've been able to maintain their production. I mean, I've talked to some energy folks in the past who would predict that after a few years, just from a maintenance perspective, not having Halliburton and others there to service them would lead to all kinds of issues. They've seemed to have been able to maintain that production.
They've held up relatively well. What we don't know is if they're blessed with some fairly low decline reservoirs. And for your viewers, oil and gas, the way it works is you don't produce the same amount every year. As you're producing this oil from under the ground, pressure starts to deplete, the ability to get it out goes down, and production falls over time. And that's anywhere from 5 to 15% per year. With the sanctions, it makes it harder for them to get Western technology and Western equipment. So in theory, their production should start to roll over. What we don't know is you can do things that create long-term damage to your reservoirs, but maintain production in the short term. And so what we don't know is if there are going to be some intermediate to longer term implications of holding production up. So it is not an inexhaustible resource. They need they need Western technology to efficiently produce. And we saw their drilling was down year over year for the first time in 2025, probably because they're running out of some of the parts and equipment and stuff like that. So I think that we will see this. If it goes another 4 years, their production's coming down. But
Gotcha.
So far, they've been able to pull those reservoirs and keep it relatively sustained.
Maybe we'll transition a little bit to Venezuela and what's going on there. But maybe as a segue or kind of link, it seems like both Venezuela and Russia are or were big users of shadow fleets. And how do those two pieces fit together?
The way that Russia has evaded some of the sanctions is you put oil on really old tankers that don't allow themselves to be tracked, and you sneak into port, sneak out of port, sneak to a customer's destination. And the shadow fleet numbers in the many hundreds of vessels. They're all really old. And so what you've seen is the U.S. has started to crack down on that. When it wants to, it can. It did it in Venezuela. It's doing it on the margin with some of the Iranian crude. So there's a bit of a look away factor associated with tracking these vessels. And in Venezuela, they're a 1 million barrel a day producer. 800,000 barrels a day of that was going to China. Post this interdiction, that crude's coming toward the U.S. and being refined here. So the shadow fleet issue is one where I think we could crack down if we wanted to. The question is just what's the will to do it?
Gets back to what you want to pay at the pump.
That's right. And before the midterm elections in the U.S., it's unlikely that the current party wants to have anything to do with some sort of a decrease in affordability around gasoline.
Venezuela has massive reserves. It has been grossly mismanaged for a long, long time. What is the ability to turn this around? And is a lot of the talk from the majors just talk, and that just trying an appeasement to the Trump administration? Are we really going to see that much new production coming from Venezuela?
The way we should think about this is 3.5 million barrels a day was their peak production in the 70s. That went as low as 400,000 barrels a day and it recovered back to a million. So from a million to 3.5 million is a pretty big gap. I think about it as a million to 2 million barrel a day opportunity. And to put that in context, Guyana was the biggest thing that happened in oil and gas in the last decade away from shale. And Guyana is producing a million and might be max 1.5 million at peak. So this is a really big deal and really big opportunity in a known hydrocarbon basin with lots of reserves and, hopefully a lot of low-hanging fruit because of this mismanagement. So the only problem in Venezuela, big opportunity, some smart people that know how to manage oil and gas projects. The big problem is, are you going to get paid for it? Are you going to get taken advantage of? Are they going to take it away from you? You're going to put $1 billion in and get repatriated like we've seen in the past. And so the sort of above ground risks have to get addressed. And so I think everybody in the industry is very interested in Venezuela because the prize is big. Their willingness is going to be, it's anywhere from Exxon saying uninvestable to somewhat, I don't think people are going to rush in there because how do you get paid? What are the hydrocarbon laws? What are the security issues? What is the way to get your money out of the country? So I think we're going to see 1 million barrels a day, maybe creep up 100,000 barrels, 200,000 barrels in the next year. That is literal low-hanging fruit. And then beyond that, what are the rules? What are the laws? I think it takes 3 years to get 500,000 barrels a day out of there. So I think by 2029, it's 1.5 million barrels a day, but 2029 is a long way away. Might go faster. I think we got to watch the rules.
It's probably a boon for the Gulf Coast refiners, right? I mean, isn't Venezuela the heavier crude? You probably know the history of this more. Is that a lot of those Gulf refiners are really set up for Venezuela? They weren't built for the kind of lighter that we produce because they were built a long time ago, and they're hard to build these things.
Exactly, and if you think about it, the heavier crudes that Venezuela produces tend to trade at lower prices. If you've got a refinery that can take lower, heavier crudes, meaning lower priced crudes, your spread, your refining margin can be higher on those. And so when the U.S. went into Venezuela and that oil got redirected to the U.S. refineries, what did it do? Cheaper feedstocks into Gulf Coast refineries, in theory, means potentially cheaper gasoline. Interestingly enough, right? So probably not a coincidence. I don't think that was the catalyst for the Venezuela action, but it's certainly a positive outcome as it relates to U.S. affordability.
All right. So maybe the wild card here is Iran. Talk about Iran and their oil production.
Yeah. So Iran is a 3.5 million barrel a day producer. Most of that sneaks onto some of that is unsanctioned, some of it is sanctioned, most of it is into the market. So Iran's probably producing at pretty close to full capacity, but they're 500 miles away from 30 million barrels a day of production in the Middle East. And so anytime there are tensions associated with Iran, you have tail risk that something bad could happen in the region. And if it did, oil's not going to go from 60 to 62. Oil goes from 60 to 102. The tail risk is a bottleneck of 20 or 30 or 15% of global supply. So that's why every time you see issues develop with Iran or these tensions build, that's why oil tends to creep up. And today it's probably discounting a 25 or 30% chance, not just that there's a conflict. I think it's important. Last June, we had a conflict, but no loss of supply. So oil spiked and then came right back down.
They didn't hit any of the oil refineries at all, either the Israelis or the U.S. Is the big risk, though, them closing the Straits of Hormuz? Isn't like, I forget the number, but it's a large number of oil production that goes through there. So what does that What does that mean?
Yeah, 20 million barrels a day goes through the straits. It's like an 8 mile wide channel. Iran's on one side of it. And so their hammer, their threat is always, we're going to turn that off. What's the interesting dynamic, though, if you go back to June, the Israelis, the U.S., nobody touched the oil infrastructure. And the reason it matters is because both sides know that's sort of a real tipping point. If the Iranians start playing havoc with Middle East supply, then the U.S.'s reason to be cautious goes down. If they're playing bad, we just play worse. If we go in and meaning Western allies, go in and do something to productive capacity, we pay the price on higher gasoline. So everybody, I think, in a rational environment, nobody touches the golden goose. Leave the golden goose alone. This is my personal view. The biggest risk in the Middle East with Iran, if they are backed into the corner and have nothing to lose, then they start lashing out. They've done it in the past. They've lashed out to Saudi Arabia, for instance, produces 10 million barrels a day. If they've got nothing to lose, then they can really create problems for the U.S. And so what we've seen so far is there's always an off-ramp in these issues. But who knows? Maybe there won't be if this continues. We'll just have to watch. But I tend to think it's a tail risk, not a high probability, that anything that happens in Iran winds up meaningfully impacting productive supply of oil.
Obviously, all these situations, Russia, Ukraine, are horrible. People, many people have lost their lives. Even minimal in Venezuela. But it is interesting how in all these situations, we don't like you, but we're not going to touch any of your energy or your oil or anything like that, because that'll inflict pain on us. It's kind of like this non-written kind of rule that everybody plays by in all of these global conflicts.
That's right.
Fascinating. So maybe let's try to put this all together. I mean, you talked a little bit about some of your investment views. You mentioned natural gas, kind of bullish on natural gas in the interim period, maybe longer term, LNG gets going and floods the market. So maybe let's talk, oil, let's talk nat gas, let's talk public, let's talk private. So put this all together. What's your general view of the investment landscape?
The way I tend to think about this is the commodity is going to have volatility. You got to think about what is the average, what is the equilibrium price? And the way I tend to view it today is that we are below the equilibrium price for oil. I want to be a countercyclical investor. I want to get involved in commodities that are trading below their long-term average prices. Why? Because we're probably headed back to the long-term average price. You can do that privately. We do it with a couple of our strategies where we drill wells out in the Permian and produce those wells. Public markets have a lot more volatility to them. And therein lies the opportunity and the challenge. What we tend to see is that the public stocks tend to follow commodities more closely and tend to get scared at the wrong times. I would say oil goes to 50, I want to buy it hand over fist. The problem is public markets are puking it. The answer is you want to buy it in the public markets, you want to buy it in the private markets, and think about this equilibrium price and think about this, particularly from my perspective, this kind of bull scenario that's developing in 2028 plus. So to put it all in, natural gas, I think, has more of a longer term growth thesis and easier supply. So I'm taking the over on gas in the near term from a price perspective and the under on oil. I want to buy fear wherever I can find it, because I do think that generally we're below equilibrium prices. And so the answer is, if you see oil at 50, put some money into it, and you see oil run to 90, take some money out of it. It's a cyclical commodity. You want to be countercyclical. So we like it here, realizing that it could be tough slogging for the next 12 months, but that's okay.
Thank you for kind of putting that all together for us. So if listeners are interested in learning more about this industry, any good books or publications you can point them to?
I wrote down a few because I anticipated this question. So there's a well-known energy guy named Daniel Yergin. He's
amazing. Yep.
He's written 3 books. The Prize, which is the first one in I think 1990. He wrote another one called The Quest in 2000. And he wrote another one last year, which is called...
That's like the new map or something.
Yes, exactly. Good job. Yes. New map.
I've read them all. They're absolutely amazing.
He's good. A little more politically charged, but there's an interesting book called The Moral Case for Fossil Fuels that talks about the kind of dynamics between decarbonization and hydrocarbons. And then Vaclav Smil has written a good book, Energy and Civilization, Vaclav Smil. So those would be the ones. And then if you want some fun reading, there's a book called The Big Rich, which followed some of the families that started sort of the Texas oil boom.
I haven't read that one yet.
The Big Rich. It's really interesting. It talks about the hunts and some of, it's back in the 40s and 50s. So it's not going to help you with what's happening today, but it's a really kind of interesting read about some of the wildcatters and the development of the oil industry.
It's kind of like what was the Frackers was another one
Yes.
that came out that
Yes.
that was kind of the backstories of all these really interesting people that kind of led to the shale revolution. But yeah, I love those books. Those are great. Outside of energy, I know you kind of eat, sleep, energy. What else do you do? You have any hobbies? So
I have a 6.5-year-old daughter. So my hobbies are now going to dance recitals and kids soccer games. But I do love reading fiction books, and I love watching college basketball, and I love traveling. So I just got back from Argentina this week, and I've been to Africa a bunch of times. Love to travel.
That's great. So I love that you're a dance dad. That is wonderful.
Painfully a dance dad.
I love it. So favorite fiction book, since you're giving us book recommendations.
Favorite fiction book. I read a book called, best ever is The Stand by Stephen King. That book is
very good. Yeah.
It's old now, but that's an amazing book. Read the abridged version, not the unabridged version. The stuff they cut out was worth cutting out. And then the one I really enjoyed 2 books in the last couple of years. One was called The Great Circle by, I think, Maggie Winstead. It follows a woman who circumnavigates the globe back in the 50s and has a neat modern day arc to it. And then I read a book called Playground. Can't remember the author's name, but it has sort of an AI tinged story. It follows some really interesting characters and how technology changed their life. So Playground, The Great Circle, and The Stand.
That's good stuff. And maybe we'll end with one fun fact that nobody knows about you.
Ooh. One fun fact. You would not know it from looking at me, but when I was in high school and college, I had very long hair. So there you go.
For those of you who are just listening and not watching the video, he is short hair. So
You're being kind. I have no hair on top. So yes, that's an interesting one. Most people that I have met in the last 20 years have no idea I used to have long hair.
Well, it looks great on you. I got to say, it's a great look. It's a great look.
Thank you, Craig.
And this was a great podcast. So, Dan, thank you so much for just sharing your wisdom on all the energy markets, the geopolitics of it all. We covered a lot of ground, and I thought this was amazing. So thank you.
Greg, thanks for having me on. I really appreciate it.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed with the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.